Frank Sonnenberg once said, "Life isn't about the number of ups and downs that you experience, but how you deal with them." First things first, I've got no idea who Frank Sonnenberg is. I might as well have said, my nan said this, but that doesn't matter. Frank is talking about the emotions and pitfalls of life, but actually this quote can be applied perfectly to investing in stocks and shares. Markets, like emotions, go through periods of highs and lows. And logic would suggest a strategy of buying in the lows and avoiding putting money in when markets are too high would see you profit more in the long run. But today I'm going to put forward some data that will show you, even if you could time the market perfectly and only buy in at the lowest of the lows, it would probably still be a terrible idea. This is an important lesson for any beginner because, after all, investing isn't about the ups and downs you experience. It's about how you deal with them. Hi guys, my name is Tom Morgan from the YouTube channel That Finance Show. I'm a UK-based, fully qualified financial planner and advisor, and I'm today coming to you in collaboration with the good people from Trading 212, who want to help you make smarter decisions when it comes to investing. But remember, nothing in this video should be construed as financial advice. Like any good story, this one starts on Reddit, where the brightest minds in the universe gather to discuss some of the most complex quandaries, like the scholars of chairs underwater, or maybe it's the fine folk of trees sucking on things. This is my favourite one. It looks like he's biting down in preparation for something painful. Maybe it's because the guys from Bread Stapled to Trees are having their way with him. Anyway, I digress. I always digress. Today's story comes from a post made 3 years ago in the rather bland-sounding Reddit group Financial Independence Reddit by user Jer Schneid. Jer Schneid is actually Jeremy Schneider, who runs the Instagram page Personal Finance Club, so all credit to him for providing this data. In this post, Jeremy describes the investing journey of three friends, Tiffany, Brittany and Sarah. It's 1979 and the three friends meet up for a face-to-face conversation, something people did in the past before COVID and the internet. They all want to start investing and agree they can afford to invest £200 a month into the S&P 500, the top 500 or so businesses in America. So they agree on the amount and what they are going to invest in, but what they really cannot agree on is when they should be investing the funds. The story aside, what Jeremy has done here is taken 40 years worth of market data and compared it to you investing £96,000 over those 40 years, which works out to be £200 a month. He looked at three different scenarios, investing at the worst times ever, so right at the top of markets right before they crashed, versus the best times over those 40 years, right at the bottom of each market fall, and then finally against just consistently investing your £200 a month, come rain or shine, whatever the weather, good or bad, you just sucked it up like a tree on a fence post having bread stapled to its backside. So the three friends clearly had time on their side, and it's this long-term investing approach that's really the key to their success. But the difference in results is still pretty striking, which is what we'll look at now. So when they sat down 40 years or so later to look at how they'd done, who do you think had done the best? Tiffany had terrible timing. She saved her money in a high-interest savings account and only pounced on the S&P 500 the day before a major crash, right at the top. Black Monday in 1987 or the day before the financial crash in 2008 are just two examples. As she watched her investments evaporate, Tiffany never sold. Instead, she left her money at work and continued saving in a savings account, ready to pounce at the next market high. At the end of the 40-year period, Tiffany had invested her £96,000 and had a very respectable £663,594. Really not bad considering her awful timing. Okay, so now Brittany, who is arguably one of the best investors of all time. She nailed it like it was toast on timber. Saving her money again in a high-interest savings account and only investing at the bottom of the four biggest crashes over that 40-year period. Brittany could not have bought at better times and she was rewarded. She turned her £96,000 into £956,838. And then we have Sarah. Not interested in market timing or trying to guess when to buy, she simply got her £200 and slapped it into the S&P 500 when she got paid. No high interest savings accounts, just get paid and invest. consistently buying over the 40-year period, and Sarah ended up with £1,386,429. But how is that possible? How can Sarah, with her lazy approach, beat the investing genius that is Brittany with her perfect market timing? There are a few factors at play here, but the key one to understand is the concept of having your money at work for you. Brittany, with her impeccable timing, only invested a handful of times over the 40 years. This meant for large amounts of time her money was just sat on the sidelines earning a 3% rate of interest, which sounds incredible versus today's rates, but still didn't deliver the same results that Sarah was getting through being invested. Dividends, which are the share in profits you receive from a company for owning shares in them, are a large part of the total returns we as investors make. Estimates predict that since 1926, 32% of all the returns of the money made from investing in the S&P 500 have been from dividend payments. The rest is the growth of the value of businesses. So by not being invested and having your money sat on the sidelines, you're instantly foregoing those returns. Sarah did so well because by having her money in the market, she was able to benefit from the compounding effect of continuous investment and the reinvestment of those dividends. So while it may seem surprising that she beat Brittany, the truth is, they weren't really competing in the same race. Brittany and Tiffany's attempt to time the market meant they spent large periods of time with cash in the bank, and this was the most costly mistake for them. But can we just take a second to marvel that all three of these individuals made a shed load of cash? Even Tiffany, with her terrible market timing, did okay, and that's more a feature of long-term investing in general than it is about market timing. Now, the data we just explored focuses on when the best times to buy are and assumes that you just bought and held. There is one area of market timing which, if you could pull it off, would see you do better than any of these investors. This is the idea of pulling your money out of the market at its highs and only buying back in at the lows. Essentially timing the market with your whole portfolio, trying to miss out on the significant declines of the stock market by selling everything right at the top and sitting in cash and only looking to buy back in when it reaches its low. It sounds simple enough, doesn't it? But it's almost impossible to do consistently. Even the best investors in the world fail to do this. In fact, you can count the number of people that have successfully timed the market in this way on just one hand. The problem is, you don't just need to be right in your assessment of the market, you also need to time it correctly too. Michael Burry, for example, came out and said he felt Tesla was overvalued and shorted the stock, essentially betting against it. He felt Tesla's price would fall. He was right, it did fall. The problem is, he was way too early to the party, and Tesla's price rose significantly after he made the bet, wiping out millions of dollars from his fund. In investing, being early is akin to being wrong, and market timing involves just that, perfect timing. And if the smartest people in the world with all the resources and all the knowledge can't do it, then us mere mortal beginner investors should probably be real with ourselves and realise that we can't do it either. I could never have predicted the market collapse that came with COVID back in March 2020, and more so could I ever have predicted how quickly markets would have recovered straight after. And it isn't just me who is saying this. Literally the greatest investing minds ever have said that a strategy around buying and selling at market tops and bottoms is deeply flawed. Jack Bogle said, "The idea that a bell rings to signal when to get into or out of the stock market is simply not credible. After nearly 50 years in this business, I don't know anybody who has done it successfully and consistently. I don't even know anybody who knows anybody who has." If you're still not convinced and think timing the market is a good idea, then I'll leave you with this. Over the entire 40 years that those ladies at the start of this video invested, that's 10,000 days to be invested. Well, just 10 of those days accounted for nearly 2/3 of all the returns on offer. Just 10 days out of 10,000 was where all the action was. So by timing the market, buying in at the lows and selling at the highs, you're saying that you're good enough not to miss any of those 10 days. That is going to require a mammoth level of effort, a genius level of intellect, and a level of predictive foresight that no one has ever demonstrated before. I don't know about you, but I've got much better things to do with my time. Me and the team at Trading 212 love putting these videos together for you. I hope you enjoyed that. Please give the video a like and consider subscribing to the Trading 212 YouTube channel with notifications turned on so you don't miss any future uploads. And if you're feeling really kind, could you head on over to the App Store or Google Play where you can leave up to a 5-star review for the Trading 212 app just to let others know how good you think it is. Until next time, my name is Tom Morgan from That Finance Show. Thanks for watching, and I'll see you on a video real soon.